looking at all the trade tensions with China, looking at people being concerned that things really aren't going to get done, I guess I'm still a little surprised that we haven't seen more of a sell-off if that's the case.
Yeah, I think that's right. And I think there is more downside to equity markets from here. I think equity investors are rather complacent about where we are right now in this phase of the trade war. And what we saw last week was U.S. stocks mostly recovered from the lows after the administration sort of walked back some of its comments on the trade war. But I think the real key here is what's happening in credit markets, where we're seeing credit spreads relative to treasuries continuing to widen out. And I think that's sending the important message that there is something that we have to be careful of, that there is a warning out there. And if you go back to like last September, September 21st, equity markets peaked, and then they fell 19.8%. By December 24th, all throughout that period, credit markets were rather orderly, at least through the first couple months of that decline. So equities led credit lower, and that's a false alarm. This time, we're getting credit spreads widening out while equity investors are remaining complacent. I think there's the warning. It tells you that this phase of the trade war is truly a lose-lose for the U.S. and China.
I mean, last time around, last fall, it was really probably the Fed that was the bigger issue, not the trade war, right?
Well, of course, it was the Fed. It was also that, the markets were at that point, say, priced for perfection because they just saw, all of these various different risks, coming out with very, call it, favorable outcomes. So it was the combination of a Fed mistake. It was slowing growth and all those other things that triggered the pullback. My only point here is that when you have equities leading credit lower, it's generally a false alarm. What we saw this past week was the exact opposite, where the credit spreads continued to widen out while equity markets remained, say, more complacent and recovered. And the lose-lose here is that the U.S. could face both slowing growth and higher inflationary pressures due to these tariffs. If you look at the tariffs that were implemented last year on things like washing machines, washing machine prices ended up going up by about 14% through the course of 2018. Same with steel and aluminum. Right. So I think now the risk is we're going to see some inflationary pressure on these items that have been newly tariffed, and markets are not pricing that in.
Mohamed, you still think that China faces a much bigger risk here?
Oh, I do. I think first Joe is absolutely right in saying that the outlier were U.S. stocks, not just relative to credit, relative to government bonds, relative to stocks elsewhere in the world. Let me give you an example. In the last month, the S&P is basically unchanged, down 1.5%. Emerging market equities are down 10%. So we've seen this massive divergence in the U.S. Now, part of it can be explained that the U.S. is in a better place to deal with higher oil prices, and it's in a relatively better place to deal with the trade tensions. Right? Remember, we win a relative trade war. In absolute terms, we suffer, but we win relative to others. So I think the markets have understood that the U.S. is in a better place than the rest of the world. The question is, can we stay there? Coming to China, I think the big realization now is this is way beyond economics. This is national security. And you're seeing
Huawei
this.
And the rest being brought into it.
Yeah, and you're seeing it play out. And I think that it's going to be hard to get to a quick resolution. And the markets have to understand that these trade tensions are going to stay with us. The best we can hope for is a ceasefire. But there's a realization in the U.S. that this is the time. If not now, when?
How do you think the Huawei piece of this plays into this?
I think it plays in a very positive way for the U.S. because the U.S. is showing that it's not just government to government, but companies are going to have to follow. And that is going to wake up a lot of people around the world.
You mean with Google's moves that it's
with Google's, and Google's not the only one, by the way, but Google's the one that's getting the most publicity.
Mohamed, do you remember your three scenarios? Have you changed those in terms of percentages? Remember what they were?
Yeah, I've brought down. So the one scenario is we get.
Let's go back to what they were. It was.
So 65% was
we get something average.
That we get some resolution. It's a short-term resolution.
Right.
Then there was a 15% chance, what I call the Reagan moment, that the U.S. actually changes the global economic dynamics, and that the rest is we end up in a full-blown trade war.
Just a mess.
Just a mess.
Yeah.
And I think what you're seeing is the status quo is coming down, and the possibility of the other two are going up. And
which one up more? Getting something Reagan-esque or
I think
hitting the fan?
I think we shouldn't underestimate getting something Reagan-esque.
Really?
Yes, we shouldn't. I think that if the U.S. goes full-blown, this is about national security, it can actually change the economic dynamics on the global scale. It really can.
And
I was going to say, but China's not going to go down without a fight, right? If you look at the success of the Belt and Road Initiative summit a couple weeks ago, China feels emboldened. They had a lot of leaders from all around the world coming in there, and they recognize they're 44% of global GDP growth at this point, and they're going to put together their own partnerships to try to trade around the United States. The knock-on effect we have to look at is if there is reduced trade between the U.S. and China, what effect does that have on treasuries?
So, Joe, the big question for me is, does China go back to 3 old habits that would actually accelerate its problems? They are, one, the household sector self-insure. They don't trust the system there, so they self-insure. So they save more, which means that economic growth slows down even more. 2, the government over-relies on demand stimulus and underemphasizes supply. And 3, the government uses the state-owned enterprises who are incredibly inefficient. If these 3 habits come back in a big way, then it doesn't matter what it does on the Belt and Road Initiative, it's going to have issues at home.
In terms of what the market's set up for, I mean, you're thinking that if things go badly, that it will mean what? If there's a situation like Mohamed just described, it would mean potentially what?
I think there's first of all more volatility, more downside in equity markets. I think if you look at the S&P 500 drawdowns in an average calendar year, on average the S&P is going to fall about 13% in any given calendar year. We haven't seen that yet in 2019. My guess is
we started on December 24th from an incredibly low.
From an incredible low, and we went up.
Move the calendar a week.
Exactly. Yeah, we went up 26% from December 24th till the markets peaked a few weeks ago. But I do think we'll see the volatility. Now, the silver lining to all this is I don't think that we're at the end of the economic expansion. I think the cycle will continue on longer than most people expect, which means we could see a recovery. So even if earnings growth comes in flat for 2019 because of trade and because of the strong dollar, I think there'd be a recovery in corporate profits in 2020. So if we do see the volatility that I expect, I would not use that as an opportunity to get more defensive and to move to the sidelines. Rather, I would go the opposite direction, which is lean into cyclicals and lean into risk, because I think we will see recovery. Now, interestingly, we've seen a massive rotation out of stocks year to date in excess of the outflows that we saw in the fourth quarter of 2018. So when the markets were plummeting in 2018, you had outflows from U.S. equities, but the outflows year to date have exceeded that. So in other words, people have not really embraced this recovery whatsoever, and they're still getting defensive. I would go the opposite way. I think if we do get the volatility, I think it's a buying opportunity for both equity and credit risk assets.